So model specification and misspecification. This is more generally than regression models. We're going to talk about some ways in which you can misspecify your model and then end up getting results that look significant when they're actually not, because just the assumptions that the model makes and the tests make are just not, they're just violated. They're not satisfied. So one that's similar to the multicollinearity that we were just talking about is the exclusion of important variables. Now, what does this mean? Well, let's say you're trying to model the price of Apple or the returns of Apple using LRCX, which is a semiconductor manufacturer. Now, this might seem to be a pretty reasonable thing to do because they're in the same industry. You'd expect there to be a relationship between them. But as it turns out, if you look at the R-squared values of the relationships between these guys, LRCX and Apple is doing really well over this time period, 2013 to 2015. So you might look at this and be like, wow, R-squared of 0.91, I need that, right? But you got to be careful because you've excluded an important variable, and almost always your model should include this very important variable, which is the market, right? The broad market. What is it doing? How's your algorithm doing compared to the broad market? You know, how is this stock doing compared to the broad market? So you can see here that the relationship between LRCX and SPI is 0.87. That's like, we don't have a confidence interval around this. So it could, sorry, it could effectively be the same. We don't know. And then also Apple and SPI have 0.8. Again, we don't have a confidence interval around these numbers, so like they could effectively all be the same number. The point is they're all high. There's a strong relationship. So if you're making this model between LRCX and Apple, and then you realize, uh-oh, SPI also has a strong relationship between LRCX and Apple, then you probably want to step back and be like, all right, what's driving what again? Probably SPI is driving both LRCX and Apple, and so you want to include that in your model, right? And what you can see is if you move the time period to a much broader time period of 2009 to 2015 and do the same correlations, look at this, you can see that LRCX and Apple completely falls off that relationship, right? This relationship is not consistent. It was 0.91, now it's 0.5. There's a huge fall off, but this relationship between the market and LRCX and the market and Apple stays much more constant. Right? So this is saying that the model that uses the market to predict the returns of Apple and LRCX is a much more consistent model than the model that uses LRCX to predict Apple. Okay, so again, you've excluded an important variable, which is the market. And if you had done that and just looked at this first relationship, your relationship could very well have just fallen apart when you put your model up to trade. Inclusion of unnecessary variables. This is actually a similar example to the one that we did in the overfitting notebook, but I'm going to just go through it again because I think it's an important one, which is, let's say that you have a model and you're trying to predict the price of PG using these 4 ticker symbols, and you do a single linear regression between one that you hypothesize is in the same industry and therefore should have some relationship, and then a multiple linear regression using all of them. What you can see here is that the R-squared of the single linear regression is not bad, it's 0.71, and the R-squared of the multiple linear regression is 0.88 or 0.89, which is good. But you have to remember that this is over this specific time period, and so now you've overfit to this time period, because remember, the more complex your model is, the more you're going to overfit, and there's just no way around that. You're just going to start fitting noise to your data, and we can verify that by going to a different time period. We're going to go to the 6 months after that time period, and you can see that both models actually completely collapsed, right? Now, the important thing to note is that the multiple linear regression collapsed even more extremely than the single linear regression. So if you had been using the single linear regression, you would have lost money, but if you had been using the multiple linear regression, you would have lost all your money. So the important point here is that you want to keep your model simple, and you want to try to not include variables unless you're positive that they're going to be predictive. So if you, as soon as you start seeing yourself having like a 5 variable model, just be kind of worried, because it's like impossible not to start overfitting. Like the model will do its job, which is fitting, and it will overfit to noise in your data. And you just have to be really rigorous about testing out of sample to make sure that that model holds up. And as you can see here, both models do not. Errors in independent variables is an interesting one. So in this model looks completely innocuous, right? You've got this predicting y using constant plus coefficient times x plus some error. Great. Super simple, linear model. You can estimate it using linear regression. But let's say that x is a price. Well, let's say that your model depends on the value of something and not the momentary price, which is actually true of a lot of trading strategies. You want to be estimating the value of something, not the exact current price, because once you've estimated the value, you can compare it to the price and you can say, this is not worth as much as the current price, I should sell it. Or this is worth more than the current price, I should buy it, right? And that's kind of the center of arbitrage pricing theory. And but the problem here is that because x is a price, it has random fluctuations around the value because markets are noisy. So what's actually going on here is that you have some error contained inside x as well. And this error is going to be dependent on the size of the coefficient. So your model is just going to be kind of weirdly misspecified in this case. And you'd have to modify the model to be this, to include the fact that the coefficient is being multiplied by this error plus this constant error term. So basically you're going to not be estimating the correct amount of error, and the type of error that you experience will be weird. The ways you can avoid this is, again, testing for normality, heteroscedasticity, and autocorrelation in your residuals. If you run those three checks against your residuals, those will pick up weird model misspecifications like this. Incorrect functional form is another one. This is just easy. Let's say, like, remember in Anscombe's quartet, if you have a quadratic data generating process, but you're trying to model it with a linear regression, that's just an incorrect functional form. You have hypothesized that it's linear. It is not linear. You're not going to have a fun time. Again, normality testing your residuals, heteroscedasticity testing your residuals, and autocorrelation testing your residuals will catch those issues. Okay, they're good smoke alarms. Put them up and just do them repeatedly. Here's another example, pooling different populations. This is easy, okay? You've got two different populations. You got your data set. Unbeknownst to you, your data set contains two separate populations. You model it using one model. That model is just going to miss and never predict either well, okay? So this is actually a fairly common problem in like large-scale studies where they'll try to like find a big overarching trend, but they won't correct for like weird things that are going on in the data. Like they won't factor out things. An example, let's say that you're trying to determine something about wages. Unfortunately, it's unfortunately true today that men's wages and women's wages behave differently, right? So if you try to say something broadly about wages overall, you might be missing out on the fact that there's two populations in there that are behaving differently, and you're just not going to do a good job at predicting for either, right, if you try to average them both. So you want to be careful about that, and that's just an example. Again, this case, you'd have heteroscedastic residuals, so heteroscedasticity testing would catch this case, okay? The normality testing might as well. So again, normality test residuals, heteroscedasticity test residuals, autocorrelation test residuals. Three very easy tests. There are more tests you can do, but those are just three that will kind of catch a lot of the common cases. Here's another example in that same vein, which is we're looking at the relationship between operating cash flow and free cash flow. And it looks like there's actually a good relationship between that. So we can use a company that has free cash flow as high to predict for operating cash flow also being high, and that we can use this maybe to make money in a model. But the important thing here is that we're looking at only companies with a market cap over 100 million, which is common. You will usually kind of, when you're doing fundamental data analysis, oftentimes you'll just look at companies that are big to make sure that they're liquid and you can trade them easily. But this model turns out to be spurious because you have not scaled your data by company size. And if you scale your data by company size, you can see that this model falls apart and the R squared reduces a lot. And basically what was being picked up on here is the same as in the multicollinearity, is that the company size was a driving factor behind both free cash flow and operating cash flow. So fluctuations in those things were being driven by this masked third variable, company size. And when you corrected for company size, you can see the relationship between the two drop a ton, right? Now, maybe this relationship is still good enough for you to trade on. Maybe this is still fine and you want to use this in your model. I don't know. That totally depends on what you're doing. But the important point is you want to correct for those masked variables. You know, you're pooling populations in a way that you shouldn't, and you want to split it out into different size companies and make sure that there's no relationship between the size of the company and how good your model is. Finally, this is a really fun example that I like a lot, which is non-stationary time series. And this is just an example of a random walk, which is a very autocorrelated time series. This is the definition of autocorrelation. This is the value at time t is the value at time t minus 1 plus some random noise, right? So this is a very simple textbook random walk case. Here's how it looks if you generate 100 of them. Now the key, what we're going to do here is we're going to say, okay, let's look for significant relationships. So let's say I pick one of them, that's my data series, right? And I'm going to look for ones that are above an R squared of 0.8 with that random one I've picked. And it turns out there are 14, okay? None of these are related. They're just completely random walks. What's the issue here? The issue here is that you assumed something about your data, specifically that it was stationary. And if you want to look up what that means, there's some description in the notebook, and then there's also, you know, Wikipedia, Stack Exchange can help with that. But basically what you did is you assumed that it was a stationary series, and you tried to look for relationships within the data set, and you found a ton of them, but none of these relationships were meaningful because in reality the data set is non-stationary. And when you have a non-stationary data set, you're just going to screw up all these statistics, and they're not going to be telling you anything useful. As another even more extreme demonstration of this, well, let's say we go to the p-values, right? Because you trust your p-values because you're a good statistician. So let's just look at the ones where you do a test and you say, am I related with another walk? And you just accept the ones that have a p-value of less than 0.05, right? 0.05. Now, in this case, if you have 100 things, choosing a p-value of 0.05 means that 5% of the time you accept that you're going to get a false positive. Okay, so you should see 5 relationships being generated, but you actually see 82. Okay, so clearly something is very wrong. Clearly you haven't calibrated right. Your p-values are giving you complete garbage. And this is just an example of you've assumed something that's true, you've made a model, it's not true because you've been lazy and you haven't tested for the underlying conditions. So you can use a Dickey-Fuller test to test to see if your data follows this type of case, and a Dickey-Fuller test will basically raise an alarm in these type of cases. So that's another one you can add on to that suite if you want to. Just go read up on the Dickey-Fuller test, figure out when to use it. Honestly, the autocorrelation test will also catch this case. So my guess is that using normality, heteroscedasticity, and autocorrelation will cover most of your cases. I'm not sure if you also need to include a Dickey-Fuller test. But the general idea here is that just really be aware of any potential biases, violations of assumptions, that kind of stuff. And you know, anytime you think you might be vulnerable to something like that, just go ahead and throw tons of tests at it and just be very worried if any of the tests come up as positive. Okay, so what does stationary mean? So that's a good question. The long and short of it is I'm not going to go into exactly what it means in here, but you can think of a stationary series as it's stationary if it doesn't follow this equation, whether this equation of x sub t is equal to x sub t minus 1 plus e sub t, right? So that equation is known as a unit root, and this is just all like mathematical jargon. But the general idea is that a stationary series is driven by a data generating process that is stationary, and an autocorrelated process is not stationary, right? Because it moves around based on previous values. Kind of it's self-driven. So I don't want to get into the exact definition of stationary, because when we were making this notebook, we all sat down and tried to figure out exactly how to define stationary, and it turns out that every book defines it a little differently, and it's kind of like one of those weird things. What I would do is, stock prices are often not stationary in my experience, just based on how things behave, and so it's actually very dangerous to try to model them using like linear regression, or try to look for relationships using correlation. My recommendation in this case is, if you're worried about stationary, just do an autocorrelation test on the stock prices. And if your autocorrelation tests says, hey, if your autocorrelation test says, hey, there's going to be autocorrelation in this data set, just don't assume you can't model it using some of the techniques that you would otherwise have used. You know, you can't throw a linear regression line through it. It's not going to have a normal distribution. It's going to be spiky. As an example, the S&P 500, just if you assume that it was normal, you would have basically the max and minimum returns you could ever expect would be so much lower than what you actually see. So like, I think the record on the S&P 500 is like 10 or 12 standard deviations away from the mean. And like, in a normal distribution, those are like once in a billion year events. And we've seen like several of them in the last like 50 years. So like, this clearly, it's not a normal distribution. Clearly it's fat-tailed. Something else is going on here. And what you want to do is you want to test for normality, test for heteroscedasticity, and test for autocorrelation. And those tests will catch you most of the time. I'm sorry that I don't have a better example for stationarity. But if you're still curious, go ahead and throw a question up on the forum thread. And what I can do is I can try to get you like a formal answer. I just can't give you a good one on the spot right now. Okay, so let's see, that's the final notebook. And then the last thing I wanted to go over briefly was David Edwards' algorithm. I see here that Alan in the chat has the hand raise symbol, which I've never seen before. I don't know if this is something that I was not told to watch for this. I don't know what that means, but if you have a question, please ask it in the questions box, and I can answer it there. I'm not sure what to do with this hand raise symbol, but I do appreciate that you have done it. And I apologize for not catching it earlier. It looks like it's been up for an hour. So, oh, and also, oh, Mark also had his hand up, but I think he asked a question, so that's okay. Okay, so let me just pause again for a few seconds here to allow for editing, and then I'll show you guys the algorithm. Okay, cool. So again, I'm going to go over to the community and lecture. And the algorithm is posted on this one. And before I show you the algorithm, I'm just going to still go ahead and say real quick, so this like whole academic initiative of developing this curriculum is coming from us working with a ton of schools. So we're currently working with over 13 schools now, and basically what's going on is professors at those schools are using Quantopian to teach their classes. And so like the curriculum that you're getting is being co-developed with professors at top schools. So it's being vetted, and we're pretty sure that this is, you know, high quality curriculum. But in that vein, if any of you know schools or professors that might be interested in using us to teach, please do get in touch with me and let me know, because we'd love to help out. It's all free. We don't charge anything. All we're looking for is exposure. We really want to help professors teach more effectively. And if any of you think you might be interested or know someone who might be interested, I would greatly appreciate the lead. And then finally, we have a student-only competition, which is open only to students in classes that are using Quantopian to teach. And that is kind of a baby version of the main competition. It occurs twice a year, and you win $25,000 in an account to manage for 6 months, rather than the $100,000 you get from the main competition. Okay, so this algorithm that David released, I think is cool. It's an expansion on the algorithm that he released last lecture. And what it does is it uses Kalman filters to smooth out the pricing of securities, and then compute a spread, and then do pairs trading, which is when the spread is larger than you'd expect, you bet that the spread is going to come down. They're going to get closer to each other. So you short the one that's high and you long the one that's low. And then vice versa, if the spread is low, you assume that it's going to get bigger. So you long the one that is currently on top and you short the one that's currently on the bottom, and you assume that they're going to go in those directions. And the nice thing is because you're always long and short equally, these things tend to be real market neutral, and you can see that in the risk metrics. This algorithm has a beta of effectively 0 and a really low volatility, very low drawdown. If you could look at the performance curves here, it basically never loses money. It's just always chugging upwards. And the thing that's interesting is that it doesn't beat market returns, but that's actually totally fine. Okay, a big problem that people have is they chase market returns. The market does a ton of weird stuff. There's a ton of volatility in it. Now, if you want to be the best hedge fund in the world, get 12% per year no matter what, right? There's maybe 5 funds that can do that. And that's what Quantopian is aiming to do with this crowdsourced hedge fund, right? We want to be low beta, no volatility, no drawdown. We don't care what the market does. We're just going to deliver 12% per year, right? And the important thing is that, let's say that this algorithm, it looks like the annualized returns here are about 9%. That's totally fine, because once you've bet on something, once you're really confident in something like this that has the risk profile is so good, it's so low, your Sharpe ratio is the thing you should be trusting, because your Sharpe says that you're getting a lot of returns for the risk you're taking on. And what that means is that you could even leverage it out just a little bit to get it up to 12%, and then just have this thing that's giving you 12% returns per year that's just always going up, no matter what. This never goes down, it just chugs on upwards. And so how he does that, and I'm just going to go a very quick overview right now. And if you guys have questions, post them on the forum thread, and David will get back to you if you have any questions about how to build out certain parts of it, why he made these decisions. He's really good. He will definitely answer your questions on that. But the general idea is he makes these classes, this class of common pair trade, and this common pair trade takes in the pair that you want to trade and some parameters for how the trade should work, basically how the model should behave. And so what you can do is you can just initialize one of these common pair trade classes for each of the pairs you want to trade. So you can just swap in and out your pairs here. You can change the model a little bit. Maybe you want to adjust the entry and exit points, so you move those to be parameters of the object, the class. I actually think that that's a good idea. And maybe we'll release another version of this algorithm with more of the parameters and the initialization method. But the general idea is that you can swap in and out whatever pairs you have researched and think would be good. And then the more pairs you're trading, the more consistent your algorithm is going to be. And I don't know, a rule of thumb, maybe you want to be doing 10 to 30 pairs. And then you have an algorithm that's, if one pair screws up, that's not going to screw up your entire life, right? It's one of 30, that's fine. But again, the general idea is that you have these classes, you initialize the classes, and then instead of handle data, now this trading logic function is the thing that's scheduled to be executed every day. And this trading logic function, like I said, just uses a Kalman filter to smooth out the prices, gets the spread, computes the z-score of the spread, how far away it is from the mean based on the standard deviation of the spread observations, and then based on that z-score, enters into positions, longing the spread or shorting the spread. And then there's a few other kind of cleanup stuff that you have to do just in case weird things happen that David put in there. David started out as just somebody on the site who was using it to develop his own algorithms and trade his own money, and then became an intern here. So what I really like about his algorithms is that these things are not just academically good. These things take into account a ton of stuff that he's learned about actually trading money. And he actually runs very similar algorithms on his own money, and they do pretty well. But yeah, so you can see here, These are just classes to actually do the Kalman moving average and Kalman regression. I don't think he uses Kalman regression. He wanted to leave this code in here in case any of you wanted to use Kalman regression to compute, say, like a hedge ratio between your pairs. And if you're not sure what that is, post a question on the forums, and we will answer. But yeah, so this algorithm, I think it's a cool algorithm. It's a nice pairs trading algorithm. You guys should check it out. And then the other one that we recently saw released here was by Justin Lent. And let me see here. Yes. So this is the another algorithm that Justin released, which has some pretty cool stuff. So this focuses more on some statistical tests that you can do while you're pairs trading to try to those fire alarms that I was talking about to make sure that the conditions that you're looking for are still there. And so what we're going to think about, I'm going to think about a way that we could like combine these two algorithms into one really good algorithm. But I would definitely look at both and see two different approaches to pairs trading from two different people who come from different backgrounds. And this one focuses more on the fire alarms of making sure that there's no regime change that's been happening. And then David's algorithm focuses more on some of the nitty-gritty of like how you enter and exit positions. So they both have valuable both have valuable things to learn. But that's basically all I wanted to say today. I don't have anything extra. I'm just going to double check the questions in case there are any more questions. It doesn't look like it. And I am also just at about time. So thank you guys for coming out. Again, I'm Delaney. I'm working on this academic outreach initiative, which is developing this curriculum and working with schools. And we will have in the near future one page hosting all of these lectures that we've developed. And the goal will be to actually have like a full curriculum that you guys can learn from. Again, if you're unclear on anything, please post a follow-up question on the forums, or if it's something private because maybe it's part of your strategy that you're developing, you can always email me directly. I'm Delaney at Quantopian, and if you're unsure how to spell that, you can just go to any of these Quantopian lecture posts on the forums, and my name will be on there. But again, thanks everybody for coming. I know it's August and this vacation month, so I appreciate your attendance, and I will talk to you later.